So in this sum, we have to calculate the following ratios. Required, calculate the following ratios. Clearly showing the figures used in the calculation. We have to calculate current ratio, quick ratio, inventory turnover in days, accounts receivable collection period in days, accounts payable payment period in days, and gross, I think it is profit only, profit percentage, net profit percentage, ROCE, and asset turnover. Okay, so let's see what are the ratios that we don't have. So these are the ratios that we have to compute. So we'll start. So gross profit is directly given and sales is also directly given. So computing this ratio is not a problem. And it's a percentage. We'll compute net profit ratio. So net profit is, see, there's only one profit here, and this can either be a net profit or operating profit. So we don't know exactly what it could be. So we will compute it. But as the question is asking operating profit, we don't have any other data. So we can use this itself as the net profit. So the next one to find out is ROC is there. So ROC we'll find it out. So ROCE, we know what is the operating profit. Okay, so we'll take this as operating profit as well as a net profit because there is no other data clearly given. So we just have to find out the capital employed. So capital employed would be total assets, which is here 43,000, minus the current liabilities. So current liability is 24,000. So we can get the capital employed. So capital employed is 19,000. So this is a percentage number. So the next one to compute is current ratio and quick ratio. So we'll start with that. So for current ratio, we need the current assets. So current assets are these three numbers. So we can start from here. So current assets would be 14,000 plus 16,000 plus 500 divided by the current liabilities, which is 24,000. So when we solve, we'll get an answer is to 1. And quick ratio, we can copy the earlier formula. The only thing that will not come in the quick ratio is the inventory. So inventory value is 14,000. We can remove that. Apart from that, the ratio is going to be same. So we'll move on to the next ratios. So the next ratio is activity ratios. So we'll find out these numbers. So the cost of goods sold we have to find out, but that is actually directly given. So if you take cost of goods sold is 42,000 divided by average inventory. Inventory is 14,000. Solve this, you'll get the answer. The answer that you will get is in times. So the next is divided by 365 days. You will get 121. So we'll move on to the next one, receivable turnover ratio. So we have to get the sales. Credit sales is not available in this question. If credit sales is not available in the question, okay, you, as we said in the earlier videos, you can assume all the sales to be credit sales. So it's going to be 60,000 divided by the debtors. Debtors value is 16,000. So here we can take 365 divided by 3.75 and we'll get the day's answer. So we'll go to the next one. So for credit purchase, we have to get either the for a payables turnover ratio, we have to get the credit purchase. If it's not available, you can get the COGS. So COGS is 42,000 divided by the creditors. Creditors we can assume, as there's no other creditors, we can assume the entire current liabilities to be the creditors. Okay, we can assume it to be the creditors. So we can solve it. So we got the numbers. So the last ratio that we have is asset turnover. So for asset turnover, we need the sales. Sales is 60,000 divided by total assets. So total asset is 43,000. So the answer will be in times. So if you want, we can also find out another ratio called as net asset turnover ratio, which is equal to sales divided by net assets. So net asset refers to total asset minus current liability. So we'll check the answers here. So the answers are quick ratio is 1.27, so that's available. Sorry, current ratio is 1.27, quick ratio is 0.875, inventory days is 122, that's correct. Receivables collection is 97 days, that's correct. Accounts payable payment period, that is 209 days, that also is correct. Gross profit is 30%, net profit is 4.2%, ROC is 13.6%, and asset turnover is 3.2. See the asset turnover, they have to specify which asset turnover they want, whether it is like total asset turnover ratio or net asset turnover ratio. Okay, because we, unless they specify it perfectly, we cannot give a right answer. Okay, so that's about this sum. So hope you guys got a good idea. We'll move on to the next sum. So this sum is about a ratio analysis, and here we have some interpretation work also. So if you look at here, you are a consultant advising Associated International Supplies Co. using suitable financial ratios and paying particular attention to growth and liquidity. Write a report on the significant changes faced by the company since 2004. So the report should also comment on the capacity of the company to continue trading together with any other factors considered appropriate. An appendix to the report should be used to outline your calculations. Okay, so you have to focus on how the growth of the company is as well as the liquidity is. Okay, and you also have to write what are the various significant changes faced by the company. Okay, what numbers have changed and how they have changed. You should also comment on the capacity of the company to continue trading. Okay, so I think the company might face some kind of a bankruptcy also. So that is about the concept here. So what we'll do is we'll just first create or work out all the ratios, then thereafter we'll look at how to give a answer. So as they have given 2 years data, we have to compute for both the years. So it is 2004 data and 2009 data, so it is 5 years apart. Okay, we cannot like compute average and all. Okay, we can't compute average. For example, certain ratios, for example, if you take inventory turnover ratio, we compute average inventory. That and all is not possible here because this is 2004 data, this is 2009 data. You can't take it like opening inventory and closing inventory and all. That is not possible. So we have to find out the ratio analysis for both the numbers. Okay, we have to find it for both the numbers. So what we'll do is we'll read the question first and see what are the numbers that are available. Then we'll find out the what ratios have to be done. So the following are summaries financial statements for Associated International Supplies Co. 2014 and 2004 and 2009 data. They have given us non-current asset, current asset, capital and reserve, non-current liability, current liability. Then sales revenue, then cost of sales, expenses and interest. So all things have been put together. This is profit before tax. Tax is given, and they have also given retained earnings. Okay, I'm not sure why they have given retained earnings. See, actually, this is they have taken it as profit and tax and distributions. Okay, so this 33 does not represent tax alone. It's also dividend distribution is also like clubbed together. Okay, so we have to work out only up to this place. Okay, I think up to here, if you work out, I think this should be the kind of profit. Okay, this should be the kind of profit we should take. Tax and distribution is there, so tax and distribution are combined together, so we can't segregate that. We can also can't segregate the cost of sales, expense and interest. That was also a problem. And he says the cost of sales was for 2004 it is this, and for 2009 it is this. So I think we can easily find out the gross profit. Okay, that we can find. Trade receivable seems to be 50% of the current asset, and the trade payables 25% of the current liability. So that is about the numbers that are available. So which ratios we could compute with the available data? So that we'll check. We can find out gross profit. Operating profit is difficult. EBITDA is impossible, so we remove that. Net profit we can find out. ROCE would be difficult, so we can remove that. Current ratio can we find out? Current ratio we can easily find out. We can't find out quick ratio because inventory value is not like separately given. They have like clubbed everything as under current asset. Only receivables data they have given, so we can't find out quick ratio. Inventory turnover ratio we cannot find. We can find receivables and payables. Conversion is not possible. Asset turnover, total asset, I think fixed asset turnover is possible. We can do that alone. Working capital, yes, we can do that. Solvency, we can do that. Interest coverage, interest is not given separately, so we can't work out that. Dividend is not given separately, so that also we can't work out. So these are the values that we can maximum find out. And here what we'll do is we will try to find out for 2 years. Okay, we'll try to find it out for 2 years. So we'll put a data like this. I think 2004 we'll compute first, then 2005 I think we can compute next. So like that we can compute for so let's start. So I think we can't even find out gross profit also because even that data is not available. So we'll find out from net profit. Okay, from here we'll start. So the number would be 98 divided by 1200. Okay, and for 2005 it would be 150 divided by 3010 200. Okay, so we can tell that the gross profit percentage, sorry, the net profit profitability of the company has fallen. So we'll write it here itself. Net profitability percentage has fallen drastically. Okay, so that's about the first one. Let's go to current ratio. The current ratio is going to be 650 divided by 513, and for 2009, okay, I think the data was 2009, not 5. Okay, in 2009 it is 1000 divided by 982. So if you see here, in terms of comment, we can say that, see, the ratio should be around 2:1. Okay, so we can say that the liquid Okay, so the company seems to be having a poor liquidity position, so that is really bad. So let's find out for activity ratio how this numbers work. So the first one is we have to find out credit sales. So credit sales is not available, so we can say that okay, I think cost of sales is available. I think we can work out gross profit also. So we could have found out like this. We can take the sales number and divide and deduct the cost of sales. So cost of sales is this number 530. So we can also find out for this. So cost of sales is again 1330. So this seems to be, so the gross profit percentage seems to be stable. Okay, so that's not much of a difference. Both seems to be like very stable here. The problem starts with the net profit level. So net profit level has fallen down rapidly. So we have gone to the receivables. So receivables, we can assume the entire sales to be credit sales. So entire sales is 1200 divided by average debtors. Average debtors is, you can take the debtors. Okay, so here it is. Receivables is 50% of current asset. So we can put 50% of current asset. So current asset we have it here 650. So first we'll find out that value. So we'll find out for 2009. What is the sales? Sales is 3010 divided by 50% of the debtors. Debtors are 50% of the current asset. Current asset are 1000. So the first one is 3.69, 6.02. So both are days, expressed in days, and let's put a comment here. So the comment is, earlier they were having the receivables outstanding for 98 days. Now it has fallen to 60 days. Okay, so the company has improved the collection of receivables or debtors. Okay, from 98 to 60 days. So now we'll move on to the payables ratio. If you take the payables, we have to first find out the credit purchase. So credit purchase we don't have. So what we can do is we can get the COGS. So COGS is like cost of sales is available. So we can take that number and work it out. So it is 530 divided by the payables. So payables is 25% of the current liabilities. So current liabilities is 513. So the COGS here is for the next year it is 1330, and the current liability is 982. So we can find out the payables days. It is 365 divided by 4.13, and here it is 365 divided by 5.41. Okay, so if you see here, the company is prompt in paying the money. So earlier they took 88 days to pay. Now they are much more better. Okay, the company okay, so that seems to be really good. So let's see how well they are using their assets. I think we can work out net asset turnover ratio. So that would be a better ratio. So we'll find out total asset minus current liability, and we'll get the answer. So if you look at here, the sales is quite easy. I think we could get it from here. Okay, sales is 1200 divided by total asset. Total value of an asset would be 765 minus current liability would be 513, and for the next year the total sales is 3010 divided by the total asset is 1410 minus the current liability is 982. Okay, so it is 5. It is 5 times and it is 7 times. So we can say that the company has become efficient in using the assets. Okay, so that is what we can say, because earlier it was they were efficient for 5 times, but now they have become so efficient, it is like 7 times they are become efficient. Okay, the higher is the better. So let's get the working capital turnover ratio. So again here it's going to be the sales only, so we can copy from the above. What is going to change is the rather than having total assets, we'll get the current assets. Okay, so current asset is 650 and 1000. We can take that numbers. So it is 650 and it is 1000. Okay, so this ratio is nothing but average working capital is nothing but work current asset minus current liability. So that's what we have did here. Okay, so we can put it like this. The company is in a dangerous situation as the ratio has dramatically increased from 9 to 167 times. This indicates that the company is having high sales and is supported by less working capital. Okay, so we can't say it is like very good. Okay, it's actually very bad. If you see, the sales has increased 3 times, dramatically it has increased. Earlier the working capital was like 100, okay, roughly like 140, but now if you see, the working capital has actually become 18. Okay, so the working capital has reduced so substantially. This is a dangerous situation because the company does not seem to be having a good liquidity position. That was actually visible in the current ratio itself. Okay, so in current ratio itself, it was visible that the liquidity position of the company is falling from 1.2, it has fallen to 1.1 point. So that itself was dangerous, and working capital turnover seems to be quite dangerous. So the company should increase their uh, working capital substantially. Okay, so let's see whether their how's their debit equity ratio. We'll check that. That will give an idea. So long-term debt and shareholders equity fund. So in terms of long-term debt, we have non-current liability, which is 42 and 158. So first we'll take that. It's 42 and 158. Let's get the shareholders funds. Shareholders funds are here. Capital and reserve are put together. So it is 210, 270. So it is earlier it was 210. Now it is 270. The ratio should be 1:1. Okay, the lower is better. Okay, so if you look at the ratio, 1:1 is great. Okay, but less than that is like much more great. Earlier they had a lower debt, but now they have increased their debt, but still they can increase their debt. Okay, so the company is having a comfortable comfortable the company is having a comfortable DE ratio. So that's about the concept here. So if you want to give an overall picture, the company is facing trouble in terms of net profit percentage and working capital. Okay, so let's see within working capital which one is the culprit. If you see, current assets has increased substantially, right? Like almost like 50 times it has increased, 50% it has increased, and the current liabilities has increased again by more than 50%. It's actually like 60, okay, not even 60, it's almost like 80-90% it has increased. Okay, so the culprit seems to be the current liability, right? So, and working capital, the company should issue debt or equity and reduce the current liability. Okay, so that's what they have to do. So let's once more we will review the situation. So if you see, the gross profit seems to be great. The net profit is the problem, it has fallen. Current ratio has fallen, so we have also indicated that the current liability is the culprit. In terms of activity, see, that seems to be like really good. They have reduced their their collection period has fallen from 98 to 60 days, so they are like promptly collecting the amount. They are also promptly paying to their suppliers. Net asset has, they are increasing the efficiency of net asset turnover. Working capital seems to be the abnormal, and debt equity ratio seems to be quite comfortable. So overall, if you see, the company is facing trouble in terms of net profitability percentage and working capital only. And within working capital, it's a current liability that they have to substantially reduce. So they can easily reduce it. So the question is, can they reduce it? Okay, the question is, can they reduce it? So to have at least a 2:1 ratio here, okay, if the ratio has to be 2:1, that's ideal. That means 1000 divided by 500, that should be the number. So they have to repay 482 of current liability has to be repaid. Okay, so the company should repay 482. That seems to be the problem. The company should repay current liability by 482. Okay, so this much of amount they have to raise it from either a long-term loan or from a equity. They have to raise it. Okay, so can they raise it like that? See, to raise this kind of an amount, they should have good profitability. Say the profitability is already suffering. If we work out an ROCE, I think that also will be like quite suffering. So what the company could do is the company could stop distributing the dividends. So that can work well, right? So we can say that the company should reduce the dividend payment. So how much ever it is, they have to reduce that. There's no other way. And because of that, the reserve can rise. So let's see whether the company has reserves. See, they have told equity and reserve put together is 210 and 270. I think this should be the reserve increase. Okay, so 65 is being like going to the 210 and it becomes 270. Now the problem is, can they raise this much of 482 from the equity and debt? Okay, so they have to only partially, they have to increase from debt. So 200 or something they can, 200 or 300 they can increase from loans, and 200 they have to increase through equity shareholders funds. Okay, so there is no other way to avoid this, right? So the company should start reducing the current liability okay, so we can do that. So the company should start to delay the payment to the suppliers. So that can be one way of doing it. Thereby partially they can issue debt and equity, that also they can do it. See, the problem here is okay, would be, but this will be difficult as okay, as the company has less profit to pay as interest. So if you see, the profit is like quite less, so that is like visible here. The profit is only 17 here. So with this profit, so okay, I think it is here. Okay, with 150 profit, this profit has to be supporting the interest also hereafter. Okay, so the company has less profit to pay as interest, and also this will discourage the equity investor from further buying the shares. So what should ultimately we should do? The better strategy that we can tell for the company is the company should reduce the expenses, okay, before, okay, expenses, okay, or we can put it as operating expenses. So why have we put this? Because if you see, the gross profit of the company seems to be great. It's around 55% and it's stable. But if you look at the net profit level, it is like collapsed. Okay, so the sales is like good, it's increasing, and the cost of sales seems to be the quite higher number. Okay, So somewhere if the company could reduce this, and that could actually contribute to a better performance of the company. So if they could reduce the cost of sales, expense and interest, that will boost up the profit. And if we start reducing the dividend, we will have surplus money. With that kind of surplus money, we can attract equity shareholders and debenture holders. We can attract, we can issue the funds. Okay, we can ask for funds and we'll get that funds. Okay, so that's about the concept here. Hope you guys got a good idea. So hope you guys got a good idea about this case. We will move on to the next case. So we'll start from this case here. This case is about forecasting the SOPL and SOFP